Hello friends, welcome to our YouTube channel Binyog Bharat. Today we are going to understand commodity trading in India in the simplest possible way. In this video, I will explain what commodity trading is, how to start commodity trading in India, trading timings, margin and leverage, future contracts, benefits and risk, and finally, a real example where I made about 13% return in just 2 hours trading crude oil mini futures. So watch the video till the end, and after watching the video you will completely understand commodity future trading in a simplest manner. So guys, let's start the video. So first we will discuss what is commodity trading. Commodity trading simply means buying and selling contracts based on physical goods like gold, crude oil, wheat, cotton, natural gas, or metals. Unlike stocks, where you own a part of a company, in commodity trading, you usually trade derivative contract whose value is linked to the price of the underlying asset, which is the physical commodity. In India, most retail traders trade commodities through future contract on exchanges. The two major commodity exchanges are MCX, which is the largest commodity exchange, and then NCDEX, National Commodity and Derivative Exchange, is also there. On these exchanges, you can trade commodities such as gold, silver, crude oil, natural gas, copper, zinc, nickel, etc. But remember, traders usually do not take physical delivery. They simply trade the price movement. Next, what is the future contract? A future contract means an agreement to buy or sell a commodity at a future date at a predetermined price. For example, if crude oil future price is 7,000 per barrel, you can buy the future contract expecting the price to rise. If the price increases to 7,050 rupees or 7,100 rupees, you can sell the contract and book profit. So essentially, you are trading price fluctuation, not the physical oil. You are not buying or selling any physical oil. You simply anticipate the price movement of the underlying asset. In this case, it is crude oil. So now we will discuss regarding the lot size in commodity trading. Every commodity contract has a fixed lot size decided by the exchange. For example, gold has a lot size of 1 kg per lot, silver has 30 kg per lot, and crude oil has 100 barrels per lot for a standard size crude oil future contract, and crude oil mini is also there, which is 10 barrels per lot. Lot size helps create standardization in trading contracts. Without lot size, it would be very difficult for the trader to trade in a standardized format. Okay, because of this, you cannot trade just one barrel of crude oil. You have to buy or sell multiple as assigned by the exchanges. Now I can assume that this concept is also clear to you. Now we will discuss regarding the margin requirement and leverage, which is the USP of this commodity trading. One of the most attractive feature of commodity trading is leverage. You do not need to pay the full value of the contract. Instead, you only need to deposit margin, which is a small percentage of the total contract value. For example, if crude oil is 7,000 per barrel, a standard crude oil lot size is 100 barrels multiplied by 7,000, which is 7 lakh rupees a contract value, which is a huge amount. But you may only need around 30 to 35% margin to trade it. For smaller traders, there is a crude oil mini contract which has only 10 barrels per lot, requiring much lower capital. This is how leverage works. You need to simply put a small amount of money as a margin money to trade the whole contract. You don't need a huge amount of money to buy a lot size. You just need to pay a little amount, as little as 30 to 35% of the total contract size. You don't need to invest a whole lot of money to buy a single contract. And this is how leverage works. With 20,000 to 30,000 capital, you can control a position sizing worth 1 lakh rupees. But remember, leverage increases both profit and risk. Now I am sharing commodity trading timings in India. Commodity market run longer than the stock market because prices are influenced by global market. Typical MCX timings, there is a morning session from 9 a.m. to 5 p.m. and evening session from 5 p.m. to around 11:30 p.m. This extended timing allows traders to react to global events, crude oil inventory data, and international market movements. And now I will be sharing you on how to start commodity trading. Starting commodity trading is actually very easy. You need just 3 steps. On step 1, open a trading account with a broker. Here in the description, I will share a link to open Angel One account where from you can easily trade in commodity. On step 2, enable the commodity segment in your trading account. For example, in Jirodha or in Angel One, you can enable the commodity segment from the console under account setting and upload income proof if required. And on step 3, add margin money and start trading on your platform. Now I am gonna share a real example, my crude oil trade which I have taken on 6th of March last Friday. I traded crude oil mini future. I have invested around 25,000 rupees. Within about 2 hours, crude oil moved strongly in my predicted direction. Then return from the trade was roughly 13%. Now let's calculate the profit. So my 25,000 become 28,250 rupees and I have made 3,250 rupees profit in just 2 hours. This happened because crude oil is a highly volatile commodity. Future trading provides leverage, and even a small price movement can generate good returns. But I have taken the risk considering all the risk factor, and I have a solid foundation regarding the price appreciation which is going on the crude oil after the Iran Israel war began. So I have taken the trade with confidence and I made the profit. But remember, the same leverage can also causes huge losses if market moves against you. Now I will discuss benefits of commodity trading. There are several advantages of trading in commodities. First, high liquidity, especially in crude oil, gold and silver. Second, long trading hours which provide flexibility for the traders. And third, leverage allowing larger exposure with smaller capital. And fourth, commodities react to global economic events, creating frequent trading opportunities for the trader. Now, I will share the risk of commodity trading. However, commodity trading also carries some risk. Prices can move very fast due to global news, OPEC decisions, currency movements, geopolitical tensions. Because of leverage, even a small opposite move can lead to significant losses and your whole capital can be wiped out very easily within very short period of time. So trade with solid risk management, and so always remember 3 rules. Use strict stop loss, avoid over leveraging, and trade with proper risk management. Now the final thoughts. Commodity trading can be very powerful way to participate in global markets like oil, gold and metals. But it is not gambling. Successful traders focus on knowledge, discipline, risk management and continuous learning. If used wisely, commodity trading can become a valuable part of your overall trading strategy. Guys, if you found this video helpful, please like the video, subscribe to the channel and share it with your friends and family who want to learn about commodity trading. This is Amit Kauri signing off. Bye bye. See you on the next video.